Good morning, traders. This is your Forex market commentary brought to you by ECN. Today's commentary will encompass a wide range of discussion highlighting last week's significant euro rally on the technical front and the prevailing fundamental bias that cover risk appetite in ECB meeting. I hope that this commentary will be insightful for you in formulating a winning trading strategy. Now, first in line with this discussion, we are going to examine the euro-dollar on the technical front. Here we have the euro-dollar hourly chart. The euro-dollar pair best personify the current prevailing theme, and that is risk on is now back on. Over last Friday's trading session, the market observed a significant price action breakout past key technicals level, especially the 1.3800, and briefly test the 1.3900 zone as the euro-dollar rallied despite an upbeat US non-farm payroll print, beating market consensus. However, now it begs the question to whether the euro has enough bullish conviction for a follow-through. What the market is now expecting is a strong fundamental catalyst on the euro to sustain this bullish trend, and these may include risk-on theme and ECB policies that can work in favor of the euro. In accordance to the SSI, which is also known as the Speculative Sentiment Index that maps out retail traders' sentiment on the single currency versus the greenback, it showed that during last Friday euro rallied, retail traders have been piling onto their most net euro positions on record as traders are attempting to predict the top or take some profit taking off the sideline during this rally. There are currently around 7 short euro positions outstanding for every 1 long euro position taken up by retail traders. Analysts are marking the 1.3800 as a support level for the euro to trade above in order for this bullish bias to be maintained. Analysis of a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bullish market sentiment and recommend long positions on the euro. The hourly charts show that the single currency opened today's Sydney trading session inching closer to its established short-term Fibonacci resistance at 1.3881, while the Fibonacci support is set at 1.3871. The euro-dollar broke out from its tight Bollinger Band congestion and surpassed the 200-day simple moving average during last week's trading session in the process. This trend holds great significance as 200-day simple moving average contain more or less of 1 year's worth of trading data, and it forecasts long-term market sentiment, and currently the pair are trading above the 200-day simple moving average, which is indicative of a long-term bullish market sentiment outlook on the cross moving forward. This bullish view is also validated on the short-term moving average front as the euro-dollar pair opens today's trading session above the 5, 10, 20 and 30-day simple moving average. Collectively, this is indicative of a buy recommendation on the technical front. Briefly, let's touch on the technical indicators in the euro-dollar interval. Here we have a collection of 10 technical indicators, and consensus shows that overall there has been 4 buys, 3 sells, and 3 neutral with technical consensus of a buy. So moving on to the fundamental front on the euro-dollar market, it is important to understand the dynamic that works in favor of a bullish euro. Since the euro-dollar is highly sensitive and correlated to risk appetite, any news feed surrounding concern over the Ukrainian or emerging market issue can jeopardize investors' sentiment towards risk appetite. The Ukrainian issue is still not resolved. It can hinder risk appetite follow through as future Russian provocative moves that has been deemed to be unpredictable. Also, from emerging market concerns, the market are paying close attention to the health of the Chinese credit market and concerns over cumulative non-performing loans held by Chinese bank, as well as over the weekend one of the government-funded solar company defaulted on its first bond payment. Over the United States last week was the release of the anticipated U.S. non-farm payroll print. The U.S. Labor Department reported that the economy added 170,000 jobs in the month of February, beating expectation of 149,000 jobs. However, employment rose to 6.9%, up from prior reading of 6.6% in January. Nevertheless, the upbeat U.S. non-farm payroll should have been bullish for the greenback since it supports the view that the Fed will continue through with its continuity of tapering program. However, last Friday price action speak volume over expectation when the greenback broke down on euro rally. Another noteworthy event to consider is that the dollar VIX index has dropped to a 14-month low. Quite often, a drop in volatility implies that a diminishing in the appeal of the dollar as a safe haven when risk appetite is the new prevailing theme. Last Thursday ECB meeting minutes release showed that the ECB stand on monetary policy has changed from being aggressively accommodative to holding on neutral on the existing policy, as Draghi acknowledged that the Eurozone economy is slowly recovering based on the recent string of upbeat PMI numbers and moderate gain in CPI numbers. This allowed the market to digest this comment as hawkish for the euro. It is also important to understand that the ECB have yet to shift its position to a hawkish undertone by postponing any easing policy indefinitely or laying out a time frame for a rate hike. The ECB remain firm on current interest rate and keep main refinancing rate at 0.25%, reiterating that the bank does not see the current economic condition as robust enough to support tightening policy. Therefore, analysts are calling this rally as a false breakout lacking sufficient expectation momentum for a follow-through if the fundamental for this weak risk event does not beat expectation. The ECB also confirmed the recovery of the European banking sector by stating that the major bank will be repaying back a large portion of the loan back to the ECB. The interbank lending rate, the rate by which commercial banks charge each other, has stabilized, as well as the remaining fear of peripheral debt default when the yield curve from Spain to Italy and Ireland dropped to a multi-year low. So, in conclusion, a gentle reminder to our listeners, when trading, it is important to consider three golden rules. They are technical, fundamental, and geopolitical. If all these three factors align, then it gives you strong conviction and backing behind your trade. So good luck and stay tuned for the next commentary.